Well, I don't think there'll be any exports from China. They are exporting silver to Japan for reprocessing so they can use it in solar panels. But the demand for silver in China is greater than the production of silver in China. I think the demand side of silver is far higher than people realize, far higher than it's ever been.
But the problem here is...
Absolutely not. Let me explain this. And everybody who even mentions the word margin increase, none of them are brokers. None of them ever took Series 7. None of them ever sold commodities. I did. Okay. Now, we have to go back to questions. The margin on silver 2 weeks ago was $2,000 contract. That's a contract of, it's $20,000. That's a contract of 5,000 ounces. So the margin was $4 per ounce. Do you understand what the purpose of margin is?
To leverage up on an asset?
No, we're looking at it from the wrong end of the telescope. The purpose of margin is to protect the broker.
Oh, yes.
Okay, because if you got a $20,000 margin and silver goes up $40 or an ounce, okay, you have just wiped out all of your margin and you've doubled it in losses. So the margin has to reflect a safety barrier for the company that is doing the trading, whether it's a bank, whether it's a brokerage firm, whether it's a commodities firm. Now, do you happen to remember Lind Waldock, Lindwalcock?
No, I don't. Who is that?
Okay, back in 1998, during the financial crisis back then, Lind Waldock was a big commodities trading firm, and the commodities were trading so rapidly that they had customers that were underwater. They went to the customer, said, "You got to put up margin." The customer said, "Haven't got any money." And Lind Waldock swept it underneath the rug for years. And every quarter, they would issue checks to themselves, deposit the checks just as if they're real. And then as soon as the quarter changed, they would take the money back out. And eventually somebody realized, wait a minute, this is fraud, and they went bankrupt. So 2 weeks ago, the margin was $20,000 contract, and they raised it to $22,000. And then I saw something that said they raised it by 60%. And that sounds like a lot. But having a $30,000 or $35,000 margin on a metal that's going up $7 a day is nothing. The purpose of margin is to protect the brokerage house. They're not trying to smash silver. They don't give a damn about the price. The only thing they give a damn about is, do they go bankrupt? Now, I have actually seen reports, I don't believe them, that a major bank was shut down because it got a $3.6 billion margin call. Now, the margin call may have been real.
Financial markets are always influenced by external forces. Gold, silver, stocks, currencies, all experience manipulation in some form. Yet, labeling every move as a deliberate attack oversimplifies reality. Between 2001 and 2011, silver surged from $4 to $50, proving that markets naturally rise despite alleged suppression. Claims of intentional smashings often misinterpret standard trading mechanisms. While conspiracy theories dominate discussions, true insight comes from understanding market structure, leverage, and liquidity. Margin changes, volatility, and price swings are operational necessities, not signals of market sabotage. Recognizing this separates genuine analysis from fear-driven speculation.
But I don't think it happened because it would be amazing if they could cover that up. But the purpose of margin is not to smash silver. It's not to drive the price up. It's not to drive the price down. The purpose of margin is to protect the issuing brokerage house or bank.
But isn't the smash an artifact of the margin spike, though? Even if that isn't the purpose.
It's imaginary. Here's the problem. Way too many people, especially with silver, want to make everything a conspiracy. It's not a conspiracy. Okay, if you look at the price of 9 metals, there's a guy in Australia who has a website called Gold Charts or Us, and you can go there. If you track iron, copper, lead, zinc, aluminum, gold, silver, platinum, if you track it over 100 years, gold and silver have gone up more than all of the other metals. Now, if gold and silver were suppressed, and they actually went up more than the other metals, then the other metals had to be more suppressed than they were. There were guys running around. Silver went from $4.03 an ounce in 2001, and I called it in November 2001 to $50 an ounce in April of 2011, and I called that too. And guys were saying it was suppressed. Now nothing goes from $4 an ounce to $50 an ounce that is suppressed. So guys want to make this a conspiracy. They want to make it some kind of somebody is deliberately screwing me. I'm not losing money because I'm a bad investor. I'm losing money because of manipulation. Now that you know how I am about trick questions, name one financial market that is not manipulated.
Define manipulation.
Well, come on. You know what manipulation is. Are currencies manipulated? Yeah.
Yeah.
Okay, stock market manipulated?
Yeah.
Is gold manipulated? Yeah. Silver manipulated? Yeah. Is corn manipulated? Yeah. You could take every possible financial market. They're all manipulated. So somebody running around saying gold is manipulated, saying, oh my God, the sun's rising in the east. Well, yeah, it's true, but it's absolutely meaningless. Politicians, television preachers, and a lot of financial writers are successful because they lie to people and tell them what they want to hear. They tell them stuff that is perfectly true. Gold is manipulated. Silver is manipulated, but it's perfectly meaningless at the same time. So the margin increases had nothing to do with the conspiracy, had nothing to do with smashing the price. When you got a parabolic move like that, what do you think's going to happen?
Silver isn't just a monetary metal, it's critical industrially. China, a major buyer, dominates supply chains for silver, zinc, and lead. Minerals on docks, though technically owned by mines, are often claimed by buyers once loaded, creating geopolitical complexity. For example, U.S. seizure of Venezuelan oil primarily affected Chinese interests, highlighting the intertwining of commodities and geopolitical strategy. Industrial demand, particularly from Asia, outpaces domestic production. Export licensing, shipping constraints, and strategic stockpiling all influence price dynamics. In such an environment, conventional supply-demand analysis falls short. Physical control and logistics dictate the market more than speculation.
They raise the margin because the price is going up. If the price is going up and you're leveraged long, you're the guy sitting on a pile of $100 bills. It's the short that gets hurt, not the long. In commodities, and you're short, and they raise the margin, what do you have to do?
You got to buy.
Okay, and if you buy, what does it do to the price?
Goes up.
Thank you. So margins increases do not decrease the price of a commodity, they increase the price of a commodity. All these guys who talk about margin, 100% are full of shit. That is the most important thing. China. Now, you're thinking, really? What does that have to do with the price of silver, the price of gold, the price of platinum? Venezuela. Okay.
You're kicking China out of LATAM, out of Latin America.
Well, you're going to really enjoy this. I own part of the company that has the biggest mine in Bolivia, and they ship silver, lead, zinc concentrate 10 times, 15 times a month. When the concentrate is sitting on the dock, do you have any idea of who owns it?
I'm going to say China.
No.
Who?
China hasn't bought it yet. It's sitting on the dock. Okay. It belongs to the mine. Now, when it's loaded into the ship and the ship sails, who owns it then?
China?
If China's the buyer, absolutely. So when the United States seizes an oil tanker off of Venezuela, whose oil is the United States stealing?
China's.
Thank you. They're not stealing Venezuela's, and they keep talking about stealing Venezuela's oil. It's not Venezuela's oil. It used to be Venezuelan oil, but now it's Chinese oil. Now, that is about as close to an act of war as anything that I can think of. And the beauty is that there's something called asymmetric warfare. And when someone has a competitive advantage to you, we have 10% of our entire Navy off Venezuela. Now, as a guy that spent 6 years in the Marine Corps and almost 2 years in Vietnam, I'll tell you, we could never invade Venezuela successfully. We could kill a lot of people. We're very good at that. We showed that in Iraq. We showed that in Vietnam. We're showing it in Somalia right now. We're showing it in Nicaragua right now. We're really good at killing, but killing people has nothing to do with winning wars. So China's oil was stolen by the United States, and they wanted to respond. Now, if you think about it just a minute, we've got a 52-week year. The quietest time in 52 weeks is going to be the 2 weeks around Christmas and New Year's. So if you were going to attack the price, that would be the very best time to do it, because whatever dollars you spend has the maximum effect. This is just theory of mine. I believe somebody did something on Friday, and it was deliberate. And strange enough, the fact that we were up $7 on Friday and we're down $7 today means that hundreds of billions of dollars have literally been evaporated, and somebody gets the benefit of that. And frankly, I think the benefit goes to China. As of the first of the month, you've got to have a special permit if you want to export silver from China. So there is a very real demand issue. And I don't think for a minute we've hit the top in platinum or silver or palladium. The daily sentiment actually went down Friday for silver, platinum, and palladium. That doesn't make any sense. They had the biggest moves they've had in history. Each of the commodities was up over 10%. But the daily sentiment said people were less bullish on Friday than they were on Thursday, which doesn't make any sense. The retail investor is not in this market. Somebody's driving this market, and it's either the big hedge funds or China or central banks.
Recent price swings in silver, platinum, and palladium reveal market participants beyond retail investors. Hedge funds, central banks, and national buyers like China are moving vast volumes. Sudden spikes or drops, like the $7 swing over a quiet holiday week, signal strategic positioning rather than panic. Retail sentiment often lags, creating misperceptions. Unlike equities, commodity liquidity is limited. Industrial demand is one way and cannot be met instantly by mining output. This structural imbalance magnifies volatility. Observing who benefits from these shifts reveals power centers shaping the market, illustrating that price movement is often driven by strategic resource allocation, not conspiracy.
If you wanted to destroy the debt-based system of the West, what you would do is throw a hand grenade into the bank vault. And I think that's what just happened. And you're absolutely correct. And that's what happened earlier this year with the Trump tariff tantrum. There was a giant move in the cryptocurrencies, both up and down, and literally hundreds of billions of dollars disappeared. I think, and I'm not going to say it, I guarantee, because I don't, I think China benefits because I think the debt-based system of the West is collapsing and it's standing on the edge of a cliff, and China just gave it a push in the butt. I don't think you can have two different prices.
Right, but the arbitrage has been fairly persistent. Usually the arbitrage, they coalesce to one number, but it's been about a week now.
Well, I've written a couple of financial books, and I've made the comment in the past that anytime someone says this time it's different, you need to run to the nearest exit, not walk. You need to run. But bizarrely enough, I think this time is different. I think there are things going on that virtually nobody understands. And you have all these charlatans, and I hate to say it because it's a negative thing to say, but these guys talking about margin calls forcing the price down. It's absolute rubbish. They don't know what they're talking about. They're throwing FUD into the equation and just confusing the issue. Something happened Friday, which should have been the slowest, quietest day of the year, and exactly the opposite was true. Somebody benefited, and the only group that I could see that benefited would have been China, because China and Russia and India and Brazil and Iran understand that the resource-based system of the East and the South is overtaking the debt-based system of the West.
As debt-based financial systems strain, investors are pivoting toward real, tangible assets. Precious metals, gold, silver, platinum, act as insurance against fiat collapse. Resource markets are undercapitalized. Junior mining companies globally total just $84 billion, with the smallest sub-$100 million representing only $14 billion. Comparatively, cryptocurrencies once soared to nearly $90 billion on hype alone. Small capital inflows can dramatically amplify juniors' market value. The trend reflects a shift from paper instruments to physical and productive assets, signaling that resource scarcity and industrial necessity, rather than speculation, will drive valuations in the next market cycle.
Well, I don't think there'll be any exports from China. They are exporting silver to Japan for reprocessing so they can use it solar panels. But the demand for silver in China is greater than the production of silver in China. I think the demand side of silver is far higher than people realize, far higher than it's ever been in the past. And you have heard financial advisors say instead of having a 40-60% allotment of investments, you need a 40 and 20 allotment, and save 20% for resources. There is a shift, and it's a shift to resources. And the beauty of that, one is that we've seen there are no indications that we're at a top, even though we got record high prices. And the demand is moving down the curve. We started with gold and then silver and then platinum and then palladium. And I think you're going to see zinc. I think you're going to see nickel. I think you're going to see iron. You're going to see those prices increase because those are very real commodities. And eventually people are going to realize, wait a minute, the only way to get copper or gold or silver or platinum is to buy the equities. And they're going to funnel money into the junior resource market. And now I asked Tavi Costa, who I think is one of the smartest guys in business, if you took the total value of all the junior resource companies, what would it be? Because I needed a number. Okay, we know cryptocurrencies was 4 trillion, now it's 3 trillion. What would it be if you took all of the junior resource markets? So, well, for companies under $1 billion market cap, it's $84 billion. And I said, well, that's too high because I don't consider a $500 million or $600 million.
Is that for gold and silver or just silver?
That's for everything. All of the junior resource companies, the 1,500 stocks in Canada. So
wait, does that include, is that just precious metals only, or is that like copper
everything.
Juniors, uranium juniors, everything commodities junior? Okay.
Yep. And of course, $84 billion is not very much money. And I said, well, Tavi, that's too high. What would it be for companies under $100 million market cap? And he said 14 billion. Now, 14 billion is not even chump change. If you remember when they had that scam called Dogecoin got up to somewhere between 80 and 90 billion dollars, and it was nothing. It was a name. It's like Fartcoin, okay, that had a multi-billion-dollar market cap based on Fartcoin. So $14 billion in all the juniors under 100 million is chump change. And you pour a little bit of investment in that, you could see juniors going up 5, 10, 20 fold. And I absolutely believe it's going to happen. And I've seen it happen before in 1979, 1980. But it is going to be an order of magnitude larger this time than it was back then.
The intersection of industrial demand, geopolitical strategy, and financial system stress sets the stage for unprecedented commodity cycles. Markets are on the cusp of structural change. Supply constraints, strategic national stockpiling, and physical demand will increasingly dictate pricing. Traders must recognize that volatility is not inherently negative. It is a signal of realignment in global resource control. Investors in precious metals, base metals, and junior resource equities stand to benefit if they understand these forces. The next surge in resource prices may exceed historical precedent, driven by scarcity, industrial necessity, and the limits of debt-based financial systems.